Well, welcome to another episode of Wind Down Wednesday. This week, have another special guest. And Joe, thanks for coming back. Really appreciate it.
No problem. I think that all of my visits kind of usher in a new era of doom and gloom in the mortgage market, don't they?
I think so. I mean, I woke up this morning, I heard news about the BOE's intervention into the market and how the mortgage market's it's been going up and down, very volatile. So I definitely appreciate your availability. I know we've talked a few times recently about buyers that I'm working with and helping them get a mortgage, but also about assumable loans. I thought what we would do this week is kind of talk about some things that we talked about just most recently about the difference between paying down your mortgage or putting more down versus just paying points.
Sure.
And maybe we can start with what that is in terms of what is a point.
Yeah, absolutely. So in mortgage, actually, Rain, I inserted a few slides before we get into some of the what is a point. Just kind of wanted to cover what I alluded to in the intro. And, buyers are going to be seeing that interest rates are going to be quoted to them high sixes, low sevens now, which has been a shock to many people who started off buying in the late summer season when we were still offering rates in the fives. So that it's going to be a big shock. And one of the things we've been seeing most recently is after this most recent Federal Reserve meeting, a lot of volatility in mortgage-backed securities. So anybody looking at this top chart is going to see that the moves, those candlesticks, are getting larger and larger. So those are just one-day moves in how bonds are priced. And every time those are getting bigger, it means that the market is having a little bit more trouble deciding on what that price really should be on the underlying security.
Yeah, that's pretty amazing to see this big dip here. But also, looks like it's from the Mortgage News Daily, and how much it's moved even just within the last few days. Looks like almost close to a little over 7% now for a conventional loan.
That's right. Yeah. So this is a composite metric. They survey about 70% of mortgage loan originators of the country to come up with that rate. And so it looks like that 7% is here to stay for at least most of the mortgage lenders out there. We are starting to see mortgage lenders come up with some amazing new products that segment out certain risk classes of the market so they're able to offer better interest rates. And I think we'll cover some of that a little bit later on in this presentation.
Yeah, that'd be great because I know for a lot of buyers, having higher mortgage rates definitely has taken a lot of their buying power, and it's really been a challenge in terms of affordability.
Absolutely. So moving on, just wanted to kind of punctuate where we are today versus where we've been, right? So people who started looking in the market this year, rates have gone up 3%. But in relation to where we've been the last 30 years, this is still a relatively low interest rate environment. Many people will know somebody of an older generation who bought their first home at 17, 18, 19% interest. And so we are still in a very good time to buy a home, especially because it creates opportunities to negotiate your purchase price a little bit more. It allows people to keep contingencies, which were unheard of earlier this year.
Yeah, I think so. I think what's really tough for a lot of first-time home buyers is that they've been used to having very low rates, and it's more of how quickly the mortgage rates have gone up. And unfortunately, I think prices have not come down in terms of real estate prices as fast as mortgage rates have gone up.
That's true. And I think you would know that a lot better, especially because you're having those conversations with sellers. They're really stuck on what that home down the street was sold for, not really taking into account that their interest rate for the buyer was 2% less than the buyer's today.
Yeah, that's right. It's been really challenging, I think, trying to get sellers to lower their price and do price cuts. But I think, kind of that reality is starting to settle in with some of the sellers that I've been talking to and investors as well.
Absolutely. So one more thing I wanted to highlight before we move on to points is the difference between the U.S. housing market and the D.C. housing market. And so a lot of people will intuitively think, D.C. might be a little bit more stable because of the nature of the work in this area, highly services-oriented, government, military, versus some of the other parts of the country which are more manufacturing-based. And when the dollar has appreciated so much against the currencies of a lot of our trade partners, we're going to start seeing job cuts for a lot of U.S. exports. Just the purchasing power is not there abroad. So I wanted to highlight a few things on this chart behind us. The top line is the Case-Shiller Home Price Index. All of these lines are indexed to 1987. And this chart is showing the relative value of homes compared to 1987. The line just below it in green is showing the rest of the U.S. So we can see that for the most part, DC real estate has appreciated much more quickly and held its value for much longer than the rest of the US. In addition, after the great financial crisis, prices accelerated much more quickly out of that mainly real estate-based recession and approached the current levels a little bit more slowly than what we saw in the rest of the US. And what you're also seeing is that the rest of the US very quickly caught up in the last 2 years, really during the pandemic, where there's been a frenzy to take advantage of low rates and push up purchase prices.
Yeah, I think after living here since 2006, I've lived through a few cycles in this area, and I definitely agree with you, Joe, that there's a little bit more stability here, especially with the government and with the military as personnel are PCSing from one base to another. I'm hoping that just like last time when there was a recession in the U.S., this area will be somewhat resilient and kind of shielded from some of the things that are happening outside of this area.
Absolutely. And then the other thing I wanted to point out here is that on these bottom two lines, it's the purchase volume. And, we all realize that purchases normally happen in the spring and the fall markets with lulls in the summer and winter as people are, getting ready for school. Many people don't want to move right in the middle of winter. And so we naturally want to see these ups and downs in the market. But the main takeaway is that the rest of the U.S., the bottom line in red, has not really increased that much from its index of 1987, whereas the number of properties that are exchanging hands in the D.C. area has nearly doubled in that time. And so that's going to help with price discovery, which is an economic term for just making sure that buyers and sellers have good information on what something is worth. So, if you don't have a good recent comp in your neighborhood, it could be because nobody's bought or sold there recently. And so in the DC area, we're finding out what people are willing to pay much more quickly, and so we can adapt to that.
Yeah, that's a good point, Joe. And I would have to add to that, I think even though having a lot of comps are really important in terms of helping a buyer put in an offer, but I think with how fast the market's moving, how fast the mortgage rates are going up, it's actually, talking to other agents and seeing what things are being priced at before they close. Because if you look at a comp that was like, 3 months from now, or 3 months ago, it's really not that helpful whenever you're making an offer like today.
That's true, yeah. I've been instructing a lot of agents to try and look at what they thought the rate was on the mortgage of the buyers for those homes and see if they can extrapolate out from that. But it is really hard to determine exactly what rate they got because we don't know if it was an ARM, which are becoming very much in demand this year. We don't know what their down payment was, so it's a little bit harder to figure out what the payment terms should have been.
Yeah, that's right. But would you say, Joe, like in terms of mortgage rates, it was pretty steady until probably like in that May time frame, and then mortgage rates just started going up starting in June, and then it just kept accelerating through the summer.
Yeah, that's pretty much what happened. As the Federal Reserve continued to stay strong on battling inflation and seemingly lose at that battle, that's really what happened in this most recent week. Chair Powell admitted that there is no firm grip on battling inflation, and we've seen the markets react in a pretty major way.
Yeah, and I think he seems very kind of firm on battling inflation, and that's I think they've priced in 75 basis points in the next meeting, and then maybe another 50 or 75 in the one after that.
That's right.
I think rates are going higher.
That's true. So what we've seen in the bond markets is that 4% federal funds rate by the end of the year is what they have priced in, which would include a 75 basis point raise this next month and then another 50-point raise in December.
Yeah, so it's, on the one hand, I think it feels like it's bad news for a lot of buyers that are buying. But I feel like, some buyers are, realizing that they need to relook at their budget and, talk to their mortgage lender more often to make sure that rates haven't changed since they last got pre-approved.
Yeah, chances are they have, unfortunately.
Yeah.
All right, so let's move over into our discussion topic of today. And we're going to be talking about what is a discount point, how you can use it to lower your mortgage rate, and then reasons to and then reasons against using discount points. So just starting off, a point in mortgage speak is 1% of the loan amount. So if your loan is for $500,000 and you purchase one discount point, it costs $5,000. That cost is paid at closing along with all of your other closing costs. And so discount points don't have to just be purchased in increments of one. They are typically purchased in increments of 1/8% or 0.125, and that's just because mortgage lenders price all of their interest rate products in eighths of a percent. Oftentimes, the most efficient way to buy these discount points is when the margin from the lender side looks like you only need to buy a fraction of an eighth of a percent in order to get to the next better interest rate. And so those are really efficient ways to save what is usually about $50 per eighth of a percent change in interest for maybe only a couple $100.
So are you saying, Joe, that it might be less than a point or less than a percentage if it's like closer to the next increment in the mortgage rate?
Yeah, absolutely. So there's a lot of factors that go into how lenders price interest rates on each of the different products. And it is not always a clean, this amount of points gets you, or this eighth of a percent gets you to the next better interest rate. Sometimes it's a very small fraction of margin that you need to cover. And in those cases, the lenders can eat the difference and cover the cost, or ask the borrower to come up with might be just a couple $100 in order to offer that rate that's significantly better.
Right. Well, that's good to know. It sounds like these are just good rule of thumbs in terms of trying to understand what a discount point is in a loan.
Yeah. And so when we're thinking about, if I purchase 1 point and then if I'm thinking about purchasing 2 points, is the incremental gain going to be the same? The answer is usually no. And that's because all of the mortgage prices are being priced out based on the current yield curve. And as we know, the yield curve in the US is a bit wonky right now. So there are some weird things happening with pricing where sometimes you'll see that a 7-year ARM is priced better than a 5-year ARM, or a 10-year ARM is priced better than a 5-year ARM. And so what we're looking at is moving up at what we call our rate stack and finding opportunities for people to purchase a lower rate for less money up front, especially if we're looking at a better product. In most ways, a 10-year versus a 5-year, where you have a longer fixed term of that interest.
Yeah, that sounds really confusing, Joe. But I think, from my perspective, working with buyers, it seems like you need to have the buyer think about how long they're going to stay at a place, and if they think they're going to move or not within the next 5, 7, 10 or more years.
Yeah, that's going to be the most. Yeah, that's the most important thing that we're going to need to consider for what interest rate product is the right one, but also when you're thinking about discount points. And so I think let's go ahead and move over to the next slide.
Okay, great. Let's do that.
So another couple things that you should know about discount points: they last for the entire length of the loan. So if it's an ARM, it's going to be applied to those adjustments that happen later on, or for a 30-year fixed, it applies for every single payment for 30 years. But it's not always the best thing to do, especially in this rising rate environment, where we're kind of expecting now a light recession next year, or maybe in the next 12 to 24 months, I think is what most people's expectations have now. The Federal Reserve normally responds to that by easing monetary policy. And what that looks like is usually lowering interest rates. And so they've been aggressively raising them this year so that if we do hit a recession, there's the ability to ease the market back down from that recession. So if there's anybody out there that's banking on a refinance in the next year or two, purchasing a discount point is a complete waste of money. They will not have recouped their cost.
Right, because it sounds like what you're saying is that mortgage rates are pretty high right now, and even though it's hard to predict where mortgage rates are going to be in the future, but there's probably a good probability or possibility that the rates are going to be lower if we're going to be in some sort of a recession where the Fed, they have to respond to that recession to try to spur up the economy again.
That's absolutely right, yes. Another thing to know is you can't take that interest rate with you when you sell the home. So if this is a starter home, or maybe you're planning to be relocated for work in the next 5 to 7 years, probably also not a good use of the money as well. And then lastly, the amortization table of a mortgage, where part of that principal and interest that's fixed every month goes towards interest and principal. That amount shifts as you get further into the payment term. And so if you're saving $50 on your mortgage payment, that's not equally applied to savings on interest and on principal. It's heavily weighted towards interest in the early years of a mortgage. So what you're really doing is saving on interest paid to the bank, but you're not putting any more money into the equity of your home, which is what most people are really trying to achieve.
Yeah, I see. I'm sure you're going to explain it more in detail, Joe, but I was just thinking that especially in kind of more difficult economic times. Perhaps a lot of families, I know including myself, you want to have a little bit more of a buffer of cash, available. So just in case there's some sort of emergency, that you can decide, what to do with it versus spending it right now to kind of buy down like a point for a house that you're buying.
Yeah, absolutely. In general, we're cautioning people to make sure they have ample reserves right now, especially because we're not exactly sure which parts of the economy are going to be hardest hit in this downturn. And in general, with rates relatively low, you're still getting a really good return on your money when you're borrowing at 5, 6, 7% in the mortgage market.
Yeah, and I think with that being said, though, there's definitely a lot of opportunities, though, to negotiate what I would call a seller subsidy, where we can get the seller to help pay for the points or help pay for closing costs. So I think, negotiations becoming more and more important in today's market, especially as kind of sellers are kind of settling into this new reality and buyers are really looking for a bargain.
That's absolutely true. The cost of those points, since they're paid out of closing costs, can be covered by the seller from concessions. So that is a really good way for them to add value for the buyer for sticking with a transaction that they may be getting ready to walk away from.
Yeah, that's great.
Let's move on to this next slide.
Okay.
And this is where we really talk about what the real cost is or the real benefit is of purchasing a point. So we had those rules of thumb earlier where 0.1% in interest rate is worth about $50 a month. And so what we're really looking at is a payback period, depending on exactly what you're paying and how much the rate goes down, which is also nonlinear, is somewhere between 5 and 10 years, just a rough ballpark there. So anybody who's going to be in this home less than 5 years, throw discount points out the window immediately. It's not for you. That next category, 5 to 10 years, possibly. Let's look at the rest of the list, right? Could it be better spent on reducing the principal amount of the loan? And I think that that's really where this calculation needs to be done in a more nuanced way than what most people are doing. So most people would compare the base case of my mortgage is X. If I purchase one discount point, it's X minus 1. Okay, so I'm saving $50 a month. And the payback period is just that $50. How many months do I need to recoup the total amount outlaid? So in the example I provided here, it was a $500,000 loan, pretty typical in this area, where you used half a discount point to bump the rate down 1/8%. So you're saving $50 a month. It takes 63 months to recover that cost. So right about 5 years, like we said. But the real case that you should be comparing that new rate to is what would have happened if you spent that $5,000 on reducing the principal balance of your loan instead of purchasing the discount point. And so when you're comparing those two numbers, the monthly savings is only $25 a month, meaning that your real payback period is 100 months, significantly longer.
Yeah, that's definitely a long time, 63 or 100 month, and just for a $25 a month saving.
Right.
And like we mentioned before, it seems like it's better to have the flexibility to kind of apply that the extra cash that you have how you like. And I know for myself, in terms of setting up these payments, it's really easy to set up an extra payment a year with your mortgage lender. So that's a way to kind of, automate that into your life so then you don't have to worry about it.
Yeah, absolutely. There are also some really good other options out there for people who want to actually reduce their principal and interest payment by putting extra money towards their loan. And it's an option called a recast. And I think we'll probably do a little bit more in-depth topic on that at a later date.
Yeah, I'd love to learn more about this recast. I love the name.
Absolutely. Rain, anything else you wanted to cover on points and what you're seeing in the market?
No, I think this has been really educational in terms of understanding how points work and why or when you should be using points in a home purchase.
Yeah,
so,
absolutely.
Yeah, thanks. I guess I'll wrap up. We didn't mention earlier, just in terms of, I know the last time you were here, you were really liking this Devil's Back drink. What are you drinking now these days in the fall?
Yeah, so in the fall, I've been really liking citrus beers, and I'm a big IPA fan. So right now it's New Belgium's Hazy Like a Fox. Easily my favorite IPA out there. Goes down really easily. Just can't recommend that one enough.
Yeah, that's great. And I think for me, in terms of wine recommendation, I've been really enjoying a lot of Portuguese wines. I think it's kind of reflective of today's market where you really have to find some value when you're buying wines or even beers.
Right.
The US dollar is really strong, and I think Portugal makes some really good wines. And I just discovered at Costco, Esporal, which I've talked about on a previous session. They actually have both a red and a white wine, and it's only about $14 for the white and $16 for the red. So
that's great.
Definitely recommend us as something that I would get at Costco.
Amazing.
Great. Well, thanks again for tuning in to another episode of Wine Down Wednesday, and we will see you next week.